Gas prices, grocery bills, airfare. Across the board, the everyday cost of living for Americans is surging simultaneously. Now, economists are sounding a severe alarm. Inflation is on track to cross the 4% threshold next month. The April data confirms the acceleration. Broad inflation hit 3.8%. Energy jumped 17.9%. Gasoline spiked 28.4% in a single year. This synchronized rise across disparate sectors indicates a systemic shift in the macroeconomic environment, threatening the basic stability of the average consumer. This tracks the Consumer Price Index for 2026. In January and February, the rate held flat at 2.4%. In March, it jumped to 3.3%. By April, it violently spiked to 3.8%, the highest since May 2023. This 4-month acceleration puts significant pressure on the theory that this inflation is a temporary fluctuation, signaling instead a deeply entrenched economic problem. To understand the domestic data, we have to look at the geopolitical catalyst that started it all, the outbreak of the Iran war in early 2026. The conflict immediately choked off one critical geographic location, the Strait of Hormuz. The closure of this single waterway effectively severed 20% of the world's entire crude oil supply. The upstream market reaction was instantaneous. United States crude oil prices crossed $100 per barrel. That global supply shock translated directly into local consumer pain. The national average for gasoline hit $4.50 per gallon, the highest we have seen in over 3 years. Global demand cannot instantly adapt to the lost oil. This constitutes a perfectly inelastic supply shock, ensuring these elevated base costs persist as long as the strait remains closed. This cascading chart breaks down April CPI data. Energy bears the brunt, driven by a 28% gasoline increase. The pain transferred to staples, led by a 15% spike in beef. Airfare, shelter, and electricity costs also climbed higher simultaneously. Since energy is a primary input for global logistics, this shock has effectively recalibrated the price floor for most petroleum-dependent and transport-heavy goods. This graph shows the mathematical reality. The blue line sets nominal worker wage growth at 3.6%, but the red line tracks 3.8% inflation. For the first time in 3 years, inflation aggressively surpassed raises, shrinking real wages. You might be earning more dollars on paper, but your actual purchasing power is actively shrinking with every paycheck. This flow diagram tracks the Producer Price Index. In April, wholesale inflation jumped from 4 to 6%. This transmission mechanism is unavoidable. Businesses are paying more today and will pass those exact costs down to consumers over coming months. This means the consumer price hikes expected in May and June are already mathematically locked into the supply chain. The CPI numbers we see today are merely a lagging indicator. The institution mandated to control this crisis is the Federal Reserve. Right now, they are entirely trapped. Newly confirmed Fed Chair Kevin Warsh favors lower interest rates, but his position is meeting intense institutional pushback. This logic tree illustrates their dual mandate paradox. On the left, lowering interest rates would stimulate the economy, but it would hyper-accelerate the existing inflation curve. On the right, raising rates fights inflation, but risks crushing an already vulnerable labor market. The central bank is structurally paralyzed. You cannot fix a geopolitical supply shock with domestic interest rates. A rate cut in 2026 is now virtually impossible. Forward-looking models offer little optimism. We start with the global perspective from the OECD. They recently issued a massive revision. Their forecast for full-year 2026 United States inflation jumped from a manageable 2.8% to a staggering 4.2%. Domestic experts agree. Moody's chief economist Mark Zandi warns that American households are entering a long-term double squeeze, punished simultaneously by rising core costs and spiking gas prices. We see the same outlook when we check this dashboard tracking raw prediction market data. Traders are currently pricing in 50% odds that inflation crosses 4.5% this year. They give nearly 40% odds it hits 5%. Both qualitative institutional experts and quantitative market traders are in total alignment. The crisis will deepen before it resolves. In Washington, a stark political counter-narrative has emerged from President Trump. The president claims the current inflation is strictly short-term, asserting that prices will plummet to 1.5% the moment the war ends. Economists point out this timeline ignores global supply chain constraints. This chart tracks the minimum delay required. Even if conflict ended today, it takes months to normalize shipping and restock oil. Factoring in retail distribution, full economic recovery requires 6 to 9 months. Political promises cannot instantly override the physical time required to restart a severed supply chain. This brings us to the strict financial reality that every American must face for the rest of the year. Consumers and businesses must immediately adjust their budgets for sustained elevated fuel and grocery costs. You should delay major capital purchases if possible, and strictly monitor the Federal Reserve's rate decisions. Institutional relief is highly unlikely in 2026. The math is clear. Everyday essentials cost more, paychecks buy less, and Washington lacks an easy fix. Stay informed, stay prepared. If this detailed breakdown helped you understand the massive macroeconomic forces shaping your money, hit the like button, share this video, and subscribe to USA Trending News.